If you want to make the tax policy permanent, it cannot lose money to the government in the out years. So you have a 10-year budget window, starting years 11 to 20 and beyond, you cannot lose money. So the question then becomes, relative to what baseline are you measuring whether this is losing money or gaining money over time?
Welcome again to another episode of the Let People Prosper show. My name is Dr. Vance Ginn. I hope you're having a prosperous day. Well, today I'm delighted to bring on someone who knows a lot about tax policy, who's been in the fight for many years now, and it just does a great job overall fighting for free markets and liberty and so much more. And it's none other than Ryan Ellis. Ryan, welcome to the Let People Prosper show.
Vance, great to be on.
Well, it's a pleasure to have you on. Before we get going, let me go ahead and read your bio for the audience, and then we'll jump right into it. So Ryan Ellis is the president of the Center for a Free Economy, a 501c4 nonprofit in the Washington, D.C. area. He's focused on free market tax, budget, and healthcare policy. For more than a decade, Ellis was tax policy director at Americans for Tax Reform. Ellis is an IRS enrolled agent and has managed a tax preparation small business since 2002. So with all that stuff going on, Ryan, let me go and ask you the first question I do every guest. Why do you do what you do every day?
Well, I'm really passionate about a couple of things. One is tax policy, but I'm also passionate about making government smaller and making people less scared of the tax system, less burdened by the tax system, a lower overall tax burden, less government spending. So it's a combination of a real interest and kind of a fascination with the tax system and how it works and its intricacies, but not in the same way a lot of people have, where they turn into kind of apologists for the IRS or apologists for big government. I'm very much of an anti-government guy, and I'd like to get the IRS a lot smaller because I want to get the government a lot smaller.
Yeah, I love it. I love it. And when you're working on your small business on different tax, what type of taxes do you do in those sort of in that sort of your life?
Most of my clients, and I did about 125 different tax files last year over about 60 or 70 clients. Most of these are sort of DC area S corporations and small partnerships. These are all service guys. So picture lobbyists, fundraisers, writers, people who do a lot of the swamp creature stuff here in our nation's capital, but do so in a professional, self-employed way. Nice.
Okay. And so that's also helped you to keep digging in to know exactly what's in the tax code. I don't know how you keep up with it all the time, Ryan, after all the changes that are made. But how did you fall into love in some sense with taxes and going back into maybe your economics or was it something else that really got you down this road?
Well, I was never an economics guy. Okay. I always knew I wanted to work in politics. Yeah. I came to D.C. in the 90s. I went to the Catholic University of America because I wanted to work in politics in the 90s. And so I eventually, after a couple stints, my first job out of college, I worked for Jack Kemp over at Empower America, kind of picked up the tax bug a little bit there, working for him. And then I worked for Grover, obviously, for many years over at Americans for Tax Reform. The thing that really hooked me as far as really liking how the tax system works more than a lot of people work on tax policy, but they don't necessarily work on how the tax system works. Just for fun, when I was a kid and I had a lot of time on my hands, when I was about 22 or 23 years old, I decided to take the H&R Block training course for fun. They do these in the fall to train their sort of next tax season group of people at these storefronts they used to have much more of. This was back in the early 2000s. And they actually have you by hand learn how to prepare pretty complicated tax returns for people. And I found that I really loved it. I would do extra work. I would research online. I would ask the teacher. I would talk to other preparers that were experienced. And I found that I had a real passion. It was like putting a puzzle together where somebody gives you all these little puzzle pieces of their financial life. And you not only put it together in a way that makes sense, you also can look at that puzzle and say, here's how to build this better over the next 5 or 10 years. And it gets into financial planning from a tax perspective. It's not formal financial planning, but it's things like, hey, you want to save more for retirement? Here's the best tax advantage way to do it. You want to buy a home, you want to save for a small business, you have kids, you want to save for their college. Let's optimize your tax system and your financial planning in such a way that we can do that. And I found I had a real passion for it. And I like to say that on Earth 2, there's some non-political version of me that works and just does taxes and financial planning all day and maybe goes to a couple of Republican fundraisers, scratches political itch. But I'm the opposite. I'm the political guy who does the tax stuff on the side.
Nice. That's awesome. Not to get too nerdy on all this stuff, but are there a couple of big things many people who listen to this are also freelancers and stuff. Are there any sort of advice, just high level, you don't have to get into a lot of details, on what to think about when you're doing freelance work?
Yeah, well, the first thing to think about is, number one, stay organized on this and probably be working with somebody like me, somebody who is an expert that can advise you. Should you go get an LLC? If you have more than one owner, that means you have a partnership. If it's just you, you have a single member LLC if you've got an LLC. But then you have to make a decision. Do I want to keep that as what I call a naked LLC, which is your taxes of sole proprietorship? And eventually, if it gets big enough and I'm starting to make a lot of money and having to pay a lot of self-employment tax that I don't want to pay, should I take a look at a subchapter S corporation? If I have a partner, for example, do I want to have a partnership or do I want to have an S corporation? What type of retirement plans should I set up? People always ask me, what's the biggest tax savings that self-employed people can have? And I tell them it's retirement. You have self-employed 401ks, you have cash balance pension plans, you have SEPs really early on if you're getting started on a small business, making sure that's done properly. If you need to do payroll now, payroll is totally different than it was 10 or 15 years ago. You have a lot of great do-it-yourself payroll services now, whereas before it was a very clunky, outsourced thing that people were scared to do. Now it's a lot easier to do. So there's less of a barrier to entry to doing more complex tax situations for people. And then the record keeping. People always forget the record keeping. You have to have a little bit of accounting in your blood if you're going to be self-employed. You got to know how to do a profit and loss statement. And if you're going to do something more complicated, you have to know a little bit how to do a balance sheet. So that's why you should be working with a professional so they can train you up on those things. Keep that to a minimum amount of your time so that they can really hone down the administrative waste that you have to do, and you can spend most of your year actually growing your business.
Man, I love it. I love it. I need to come talk to you more about this, Ryan. I didn't know we were going to go this direction, but it's really good because, I started my own business, Ginn Economic Consulting, about 2.5 years ago. And man, it's been in undergrad, I did economics and accounting. So I have kind of the accounting mind. In fact, that's what I wanted to do when I first go into college was I wanted to be an accountant. You can make good money. It's a good steady income, there's jobs. But then I fell in love with economics when I started taking more economic courses, and that put me more in that direction. But as starting my own business, it's been kind of tough to figure out, okay, what do you do X, Y, and Z as you're trying to have all this other time to do the things that you love to do. But you're so right that you've got to make sure you do the insight and do a good study on all these other aspects of it, because if you don't, you can get in a world of hurt with taxes and then spending a lot more time and effort on those things. Don't you think that's right?
Yeah, and it's important to plan ahead of time.
Yeah.
The best time to sort of plan you have to have a battle plan, a business plan for how a lot of people just say, hey, I'm self-employed. Somebody's decided that they were going to give me a $5,000 a month contract and now I'm self-employed. And that's great. But if you haven't thought through, well, how do I pay taxes on this? What type of business entity am I supposed to be? What type of record keeping do I have to do? How do I do my health care? How do I do my retirement? What if I have to hire somebody? What do I get to deduct and what isn't deductible? If you don't have that conversation on the front end, and God forbid you wait until the first tax season comes along to have that conversation in retrospect, you're probably doing it wrong.
Yeah.
And you should be working with somebody that knows what they're doing so they can set these processes up for you. It's not, people like me and accountants and tax professionals, we cost a little bit of money, but hopefully we save you multiples of whatever you need to pay us, because we're optimizing your efficiency. We're making you a much, much more efficient. You're going to pay a lot less in taxes. You're going to worry a lot less about administrative headaches. You're not going to have to deal with nasty gram letters from the IRS or from your local tax agencies. You're going to be nice and structured and in a capacity to actually grow that business and make even more money.
Man, I love it. Speaking of, let people prosper, this is the way to do it. I mean, the entrepreneurship and the attitude of being innovative and everything else is just so important. And as you are working in starting your own business, as you mentioned, I mean, it can go a couple of ways. One is you don't get many clients after that and that $5,000 goes away, or hopefully you're getting more clients. And so then you're able to, division of labor, right? Speaking of economics, division of labor, specialization, allow people like you to specialize in what you do best and others do other things. And so what's kind of cool about this though too, Ryan, is your ability to not only know the tax policy side of it or taxes, not the policy, but the taxes, but you're also really big into tax policy. And you've been working on this for almost 2 decades, right? It's kind of crazy, but for a while, you've seen a lot of ups and downs throughout the tax policy. What's kind of your state of tax policy, if you will, or state of the fiscal policy that you see within the world right now?
Well, we're in a really pivotal moment right now because Tax Cuts and Jobs Act which was the 2017 Trump tax bill. The permanent part of that was the corporate income tax changes, the reform. So we had the highest corporate income tax rate in the developed world at the time, which was 35% federal plus state. We're now down to 21% federal plus state, which puts us in a pretty competitive situation. So the corporate side is largely taken care of. There's some things that were not permanent there, but the top lines of it are pretty well taken care of. On the other side of the street, though, which is, our naked sole proprietors over here, single member LLCs, our subchapter S corporations, our partnerships, they have a lot of uncertainty. And there's a lot of expiration that's happening in the tax code right now. For one thing, the top income tax rate. It's currently 37%. Next year, if we don't do anything, it's going to be 39.6% again. Another thing is we have something called the Qualified Business Income Deduction, QBI, otherwise known as 199 Cap A. And that allows a lot of businesses to take 20% of their profit and just deduct it right off of their business income, which effectively lowers their effective tax rate into the high 20s, which is a huge, huge benefit for a lot of active, mature small businesses that are out there. You've also got things like 100% full expensing, which is now down to 40% expensing for tangible personal property assets like furniture and equipment and computers and things like that, qualified improvement property. Research. So companies that are engaged in a lot of research, they now have to amortize research expenses, most of which are wages, by the way, over 5 years. They can't just deduct their wages in 1 year anymore. They have to deduct them over 5 years. So we need to get back to research expensing. Companies that borrow in order to do capital investments are being punished right now in the way in which it's called EBITDA, which as an economist is a different way of figuring profits. Right now, if you are basically punished for the DA. If engaged in a lot of things that do depreciation and amortization, which is to say business fixed investment and intangible investments in your company, you are punished now if you borrow in order to do those things. All those things are temporary or recently expired or about to expire, and they create a tremendous amount of uncertainty for what we call the pass-through sector as opposed to the corporate sector of our business economy.
Wow. Yeah. And I've talked about that some here on the show with other guests, Ryan. And I think it is really important that they do something to extend this and hopefully make it permanent. I wonder, and you brought up a good point about the corporate income tax, that part is permanent of the 21%, which I think if you add in the state portion, it's about 4.3%, right around 4%.
Yeah, you get up to about 25. Yeah,
about 25. Because there's been some discussion about bringing that down to 15%. But I know that is going to create a lot of other problems with how the structure of the extension goes into play. But I wonder what your thought is on lowering that more, or should we make sure that we hit on some of these other things first, like full expensing and the marginal income tax rates?
Well, I'm of the belief I'm with Kyle Palmer-Lau and a lot of the Tax Foundation guys on this, that on the corporate side, the rate, it's a classic Laffer curve.
Yeah.
Right. Like if you're on the low end of the rates, which we kind of are now, we went from too high, which was in the high 30s, to now we're about in the middle or even toward the lower end of the middle among OECD countries. The rate is not the real big challenge. It would be helpful to lower the rate.
Sure.
Obviously, there's an international 15% minimum tax international conspiracy that the bureaucrats are doing all around the world. I would love to get to 15 or 14 just to beat those guys.
Yeah.
So that's, I think, a very worthy effort. But if you're trying to triaging and saying, well, what's the most important thing we can do that would maximize economic growth? It really is moving toward a consumption base more on the corporate side than it is addressing the rate. If I had to pick one, I would say, look, what are we doing on making 100% expensing permanent for tangible personal property? We haven't done anything on structured depreciation for the most part. We still have a 39-year life for non-residential structures and a 27.5-year life for residential real estate property. That's way too long. We ought to be moving much more in the direction of immediate expensing, or at least something approximating immediate expensing for structures. We don't have anything like a consumption base yet on the corporate side. And I would say that's probably the priority. But right behind it, absolutely, we should be taking a look at lowering the rate. One thing that concerns me a little bit is the Trump administration's proposal. We're saying we'd like to get down to 15, but only if you make it in America. Well, what does that mean?
Yeah.
I mean, is Toyota USA made in America? Because it's a Japanese company that has a USA subsidiary that makes cars in like Tennessee and stuff. Is that made in America? Okay. How about like Chrysler if they have a plant in Mexico? Is that made in America just because it's a Detroit company? So it gets very confusing. and very arbitrary. I'd rather not have that. I'd rather have a simple, like we did in 2017. If you're a corporation, if you're a C corporation, you get a lower rate.
Mm-hmm. Yeah, totally. Not picking winners and losers, right, in the process, and potentially raising the cost in other ways for Americans if we're going to try to produce it all here. I mean, there are benefits to having production in other places. I mean, I guess that goes into the discussion right now, Ryan, about protectionism, tariffs. What is the bigger effect of having things done overseas, or not even overseas, but in other countries that are in North America? There's been this recent discussion about having a 25% tariff on Canada and Mexico, an additional 10% on China. Some of those look to be suspended for now. Other ones not. I think the ones that are under USMCA or those goods are suspended for a while or a month. But what it's led to, though, and I want to get back to the other part of the tax discussion, but I think this part goes into it all, Ryan, is I know, like when I was at OMB, the chief economist for the Office of Management and Budget, we had these large macro models that we could run through at Russ, or the Trump, president wanted to do and say, hey, Vance, can you run these models? And we would. Now, when we would run these models, we also found that, look, the trade stuff was going to be a drag, and we would express this to the president and Russ and others, but they're like, well, look, we're going to get more growth from the other places, and I'm like, yes, we will through deregulation and other things, but we've got to understand that this is a drag, and maybe and I think they're using a little bit different language now. The narrative has changed some. Like even President Trump mentioned this in the presidential address to Congress recently, of saying, look, there's going to be some hurt. There's going to be some tough times in the meantime, which I'm glad that they're at least expressing that. But I don't know that we're even going to get to the longer term benefits for what they're trying to get through those mechanisms of using a tariff. But where are you at on this, Ryan?
Well, like a lot of people, it concerns the heck out of me.
Yeah.
Twitter's been very spotty today, but I at least sent out a tweet this morning where I noticed that the S&P 500 total return since Trump started announcing his tariffs is down 7.5%.
Wow.
In a little bit less than a month. 7.5%. So I took a look at the latest market capitalization. That's between $4 and $5 trillion in shareholder wealth that's been wiped out in the last month because of all of this uncertainty. Mm-hmm. So like a lot of people, I'm very concerned about it. What I wish they would do is I can kind of see where they're going here.
Yeah.
When they talk about reciprocal tariffs. If you talk to people like Kevin Hassett and others that are more free market minded in the Trump administration, or Vice President Vance has also said this, that their goal eventually is to get other countries to take down their tariff barriers, and we're trying to use our tariffs as leverage to get them to do that. Okay, I wish they would articulate that.
Yes.
And say, because then it's like, look, this is going to be really hard for the next few months. We're basically shooting ourselves in the foot by doing these tariffs, but we have a free market end in mind here.
Yeah.
We want to have a more free market world with fewer tariffs at the end point of this. They never really articulate that, which tells me that I don't know that they have an exit strategy for what they want to do with these. Like another example is they say, well, we want to do, this fentanyl control, the fentanyl that's coming across from Canada. Well, I don't know that they've given Canada any particular metrics as to how they're supposed to measure that they're complying with what it is that they want them to do. It's a infinite horizon value that they're imposing on these other countries that it's total in the eye of the beholder whether the country's been compliant or not.
Yeah.
I wish there was an exit strategy to these tariffs that we could declare victory and not have to deal with this anymore, because it is an absolute drag, not only on economic growth, which is an intangible concept, but it creates actual problems with imports, creates problems with jobs. Everybody that has a 401k, an IRA, an HSA, a 529 plan for your kids, it's lowering the value of each of those accounts every day. So I wish we had an exit strategy on these tariffs.
Yeah, no, great points there, Ryan. One of the things that I usually try to talk about is that, we blame China and Mexico and we point our fingers a lot, but we forget the three that are pointing back at us. That we could be doing more internally to be more competitive. Part of that is by making the corporate income tax more like a consumption-based tax, like you mentioned earlier, making sure that tax cuts stay permanent. Deregulation, I think, will make us much more competitive. And in government spending, I mean, with all this massive amount of debt and interest payments and everything else, I think we're also shooting ourselves in the foot, the analogy you used there, of all these things that are going on. One of the things that brings up, though, Ryan, I'd love to get your take on this, is kind of this discussion about current policy or present policy versus baseline policy. What has been your thoughts on this? Because I know you follow this stuff really closely and have for many years. What is your thinking about it?
Well, it's the most inside baseball part of this tax reform fight by far. So I'll try to explain this really quickly without getting into too much jargon. So basically what Congress is doing is they are using a way to avoid a 60-vote threshold in the Senate known as budget reconciliation. So budget reconciliation is an expedited process that allows Congress to pass budget legislation that deals with taxes and with entitlement spending, and do so in a way that avoids a 60-vote threshold in the Senate. You can do it with as few as 50 votes plus the vice president in order to pass this in. But in order to get that, you have to comply with all sorts of rules. And one of those rules are, if you want to make the tax policy permanent, it cannot lose money to the government in the out years. So you have a 10-year budget window, starting years 11 to 20 and beyond, you cannot lose money. So the question then becomes, relative to what baseline are you measuring whether this is losing money or gaining money over time? There's two ways to do that. The way Congress has historically always done that is with what's called a current law baseline. And a current law baseline basically is a Congress goes to sleep baseline. Congress goes to sleep and does absolutely nothing and lets all the expirations that are going to happen, and does so without any stopping or any delaying whatsoever. So what that means is that next year, everybody's tax rates go up, the child tax credit gets cut in half, the standard deduction gets cut in half, the AMT comes back, all the things that are temporary from the Tax Cuts and Jobs Act, in fact, do expire, which raises the revenue baseline because we just had a massive $4.5 trillion tax increase when that happens. And so you have to raise at least that much money and then some under a current law baseline. So that's a challenge, right? Congress basically is taking the existing tax code, has to raise $4.5 trillion more than the existing tax code will collect. And that's the price of doing business to make the tax policy permanent. The other way that Congress would like to, and that's what the House budget does.
Yeah.
The Senate budget is trying to do what's called a present policy baseline, otherwise known as current policy, but I like present policy because it has different words entirely and people don't get confused.
Yeah.
Current law, present policy. So a present policy baseline says, oh, well, the tax law that is in place, you take a picture of it right now, a little snapshot picture. What's the tax law look like right now? Well, regardless of what is set to expire, we're going to assume the tax law of right now, today, as we're sitting here, is the permanent tax policy forevermore. And that's obviously lower than the current law baseline because we're not going to have all that expiration. We're not going to have all those tax increases happen. And you've also sort of tautologically made the current tax law permanent, right? So you've through the back door, through the tautology of setting the present policy baseline, you've already done and made the Tax Cuts and Jobs Act permanent. You don't have to raise any additional money to do that. The only things you have to raise money for are a few things that have already expired from the Tax Cuts and Jobs Act, the new stuff that that President Trump would like to do on tips and overtime and seniors and whatever else.
Yeah.
And if there's any hostage taking on the part of the state and local tax caucus, Republicans in the House that want to see a bigger state and local tax deduction on the individual side, you'd have to raise some money for that. But that's it. That's all you'd have to raise money for are those things. And you can find that with wasteful IRA Green New Deal credits and a few other things here and there you could probably play with.
Yeah.
It's a lot easier, obviously, to do it that way. Congress has never, I don't think, done it that way in the history of using reconciliation. So it's new. That's why I think it hasn't been agreed upon yet by the House and Senate, because I think they're still trying to get to yes with the Senate parliamentarian on a present policy baseline. But it would be a lot easier to do this tax relief on a permanent basis. Otherwise, we're going to have to find $4 to $5 trillion of new tax increase offsets in order to make what's already there permanent.
Yeah, yeah. And Ryan, correct me if I'm wrong, but CBO and others, they will assume that spending remains in present policy. Because aren't they kind of doing the opposite, right? Like if they're looking at spending, it's going to continue, but taxes, though, they're going to go away.
Yes. So if you have a spending program, mandatory spending program with a sunset date, the way CBO assumes is that it's just going to continue, that Congress will find a way to reauthorize that and it'll continue. But if they do completely the opposite on tax policy. If there's a tax policy with a sunset date, they assume Congress really meant it and that the sunset's actually going to happen. Yeah. So there's an absolute double standard there. They should normalize one or the other. In fairness to CBO, it's not as if we're trying to do much different on the spending side. We are kind of, and also there's different definitions of what a present policy baseline looks like. So for example, we currently have right now this year, super enhanced Obamacare subsidies in the tax code that are expiring at the end of this year. Are we to assume that those are permanent? Do we have to or are we cherry picking the tax policies we like and saying those are permanent, but ignoring the policies we don't like and letting them expire? this is, I think, some of the questions that's happening right now with the Senate parliamentarian of how do you actually define a present policy baseline? And also, others of good faith have brought up, I think, a very good question of what happens if the Democrats then have that power.
Yeah.
Let's say that they want to come in and they want to put in something like the child tax credit they had a few years ago, which was a $3,600 child tax credit, fully refundable with welfare checks ahead of time for everybody. They could do that, pass it 1 year, come back the next year, and then make it permanent for free, for no cost, under a present policy baseline. And we will have handed them the precedent.
Mm-hmm.
As Mitch McConnell used to say about judges, you'll regret it and sooner than you think, right? That might happen to us.
Yeah.
So there's reasons why the present policy baseline, while it's really attractive, because it would allow us to make the Tax Cuts and Jobs Act permanent without having to spend any additional money or not have to find any additional tax offsets to pay for that. It's not costless.
Yeah.
It's not easy and it's not costless.
No. And I think that's why we're seeing all the fights that we are up there and how this is taking a while. I do think, as Grover was on here recently, Grover Norquist was on the show and talked with him, I do think it's really important for them to get this tax cut done quickly and done first compared with waiting. You have the idea that if you wait longer, like they did in 2017 to December 2017, that the effects of the tax cuts don't really take effect until after the midterms. So there's also a political calculation, of course, some public choice economics about the interest, rent seeking and everything else that's going on. But it also just makes sense. I mean, if you want, the other thing here, and I loved how you explained all that. I think you did a great job, Ryan. But I wonder, like talking with people at home, what they really care about is whether or not their taxes are going to go up or down. And and if you say, hey, this is going to expire next year, they're like, what the heck? Why? And so I think by making it say, okay, your taxes are not going to go up in this case, and you're going to take less home less money, that they're going to extend this. And that's why they're including this in current policy, I think makes a lot of sense to a lot of folks around them. But there's also this question too, Ryan, about the spending part of it. I mean, we don't have a revenue problem. We have a spending problem. However, there is a revenue problem here, given that the tax code, this part is going to expire soon. So it does become kind of a revenue problem in that situation. Not the revenue being brought in, but the economic effects and incentives that it's going to change throughout the economy. But I also think that we've got to be careful about the spending. One of the things about me, Ryan, is I'm not necessarily a supply side economist. Right? Like I do think that there are incentive effects that happen when you change tax rates and everything else. However, I'm not one to say that they just pay for themselves, that you do see a reduction in revenue in the short run. They may bring about more revenue later, like I think TCJA did, the Tax Cuts and Jobs Act. But we've also got to have a focus on spending. And I see that some right now, especially on the right and the Republicans, where there's some divide that's going on there. What's been your thoughts about the taxes versus the spending?
Well, spending, it's important. I always start people off by saying you said, and you're absolutely right. We don't have an undertaxing problem. We have an overspending problem.
Yeah.
And that's not an assertion. That's math.
Yeah.
Right. So if you take a look at the last 40 years, CBO will tell you that we collect between 17 and 18% of GDP, 17 and 18% of our economic output in federal revenue. And that's where we are today. We're at just over 17% of our GDP is being collected in federal revenue. If we made the Tax Cuts and Jobs Act permanent and did all the policy we want to do this year, guess what? We'd still be collecting between 17 and 18% of GDP. So we're coming in, taxes are pulling their weight when it comes to the budget. They're bringing in what they has historically brought in. The reason that we have large deficits, growing debt, and a fiscal problem going forward is entirely 100% on the spending side. Spending has historically been between 20 and 21% of GDP, which means, of course, we've had a deficit of about 3 to 4 percentage points of GDP. Which has been manageable over time. But now what's happened is as the senior population has grown, our population has aged, more people collecting Social Security and Medicare, as we, meaning the Obama administration, grew the Medicaid program, so that the Medicaid program is a lot bigger than it used to be. And just in general government spending getting bigger on Obamacare and food stamps and all sorts of other things, our spending has gone from that 20 to 21% of GDP range that was comfortably in for the last 40 years to now it's a little over 23% of GDP. Mm-hmm. And CBO says it's going to grow inexorably to 30% of GDP and beyond by the middle of this century. Meanwhile, taxes are still in that 17 to 18% range. And you have people going around saying, well, we need a balance of tax increases and spending cuts. We don't need a balance.
No.
We need spending to come back home,
Yeah.
back to where it was supposed to be, between 20 and 21% of GDP. That's the mission. That's the mission. And if you take a look at where the outsized spending growth is, it's in a couple areas. It's not discretionary spending.
No.
It's not the things that you hear about the pork and the Doge stuff. That's all great. It doesn't actually reduce budget deficits. It's great because it defunds the left, which helps you reduce spending in much more serious ways, but it doesn't itself do that. It's in Social Security, Medicare, Medicaid, Obamacare, SNAP, student loans. And of course, with interest rates going up, net interest on the national debt is a much bigger spender than it used to be. Yeah. We can't really control that last one unless we wanted to totally monetize the debt and go into all 1970s at the Federal Reserve. But the other ones we can. The other ones we can take a look at. And if you look at it over the next 10 years, we are going to spend $54 trillion on entitlements, not including interest. So that's $54 trillion. The House budget, which is supposedly draconian and we're history's greatest monsters for the amount of spending cuts in there, it calls for between $1.5 and $2 trillion of spending cuts over the next 10 years in that area, where the baseline starting point is $54 trillion. So we're going to go from, at the most, $54 trillion down to $52 trillion of spending over the next 10 years. And for that, we're history's greatest monsters. That just tells you how hard it is to cut any spending here in Washington. And because you can do that so easily, Vance, you can do that. We're not touching Social Security. We're not touching Medicare. All we're taking a look at is, for instance, asking federal employees to kick in some more for their own pensions. We're asking illegal immigrants to please not enroll in Medicaid. We're asking 29-year-old childless single males that are sitting on their couch playing video games to please get a job if you're going to be in Medicaid. That's the type of things we're talking about. That stuff saves $2 trillion.
Wow.
That's how easy it is to actually cut spending on this stuff, and we ought to get around to it.
Yeah. Amen. Amen, brother. When you're looking back here right now on what's kind of been going on in the right, with the Republican Party in particular, it kind of feels like there's two camps to some extent. You have some folks who are looking more at pro-natalist policies, pro-family policies. You have others who maybe are wanting less government spending, lower taxes. It's almost like the old camp, the old Reagan versus the new camp. And some of them say freedom conservatives versus national conservatives and things of that nature. Just put my cards out there. I'm pretty concerned, though, about what's happening on the right, about if we're going to expand government, then how are we different from the Democrats? How are we different from what the progressives have done for so long? And while I'm big on the institution of family, I think that we need stronger families. My concern, Ryan, is that the reason why families are weak is because of too much government. Not that we need more government to come in and do this, but I get pushback from a lot of folks. But I wonder where you're at on all this, Ryan. Like, what's the kind of your thinking? Because these are a lot of our good friends, right, that we talk with all the time and have good discussions with. But kind of what are your thoughts on this?
Well, I'm a little bit in the middle, but because I start with this and saying, okay, I don't want to be a victim of zombie Reaganism or whatever they accuse us of. I don't want to start pretending this is still the Gingrich Revolution, 1994, and I don't have a new idea. That's what we accuse the left of. The left is always accused of not having a new idea in 50 years and da-da-da-da. Well, 1994 was a long time ago. 1981 was a long time ago. I don't want to be accused of that. So if you have somebody on our side coming and saying, let's think outside the box and think a little differently, let's say about the child tax credit or how we want to do family issues or whatever, I'm very open to it. The problem I think you run into with a lot of these guys is there's an old story that G.K. Chesterton used to tell called Chesterton's Wall. And these guys do not respect Chesterton's Wall. And Chesterton's Wall went like this. A guy buys a farm, and it's a farm that's been a family farm for a very long time. And he's out walking the property one day, and he sees a wall that's right in the middle of a field, and he has no idea why that wall should be there or what good that it does. And so he decides that he is going to tear down that wall. And as he's walking back, he finds that there's a farmer next door that he runs into, and he says, "Hey, I just saw this totally useless wall on my property. I'm going to tear it down. So I'm doing a good job with this farm that I just bought." And his farmer neighbor said, "Well, wait a minute. If you tear down that wall 6 months from now, when it rains for 2 weeks in a row, that wall was blocking the flooding that was going to come into your house. So I wouldn't do that if I were you. I got the same wall like that on my property." And the guy decides not to take down the wall because just because you see something that you don't understand or that you think there's a really good reason to change doesn't mean that another Chesterton idea, the democracy of the dead, those of us that did this for a long time, that maybe aren't even with us anymore, there's an inherited wisdom, and that's conservatism right there. Conservatism is that we respect the inherited wisdom of those that came before us, and we respect Chesterton's wall. I'll give you a really good example of how our friends that are sort of new right guys don't quite understand this, and they fall into this. So you see a lot of skepticism of credit card companies these days. And they say, even J.D. Vance, before he was selected for vice president, was, I believe, along with Josh Hawley, the only Senate Republicans that were on a credit card price control bill in the Senate. He doesn't like to talk about that as much these days, but he was, because I did a lot of research on Vance when he was selected. And, you saw another version that the Anna Paulina Luna was considering on the House side, along with Ocasio-Cortez, of having a 10% cap on interest rates, which is a price control on credit cards. And what that would do is it would essentially wipe out credit cards. There's no business model in which they can charge 10%.
No. And
some people, you point that out and they're like, good, people shouldn't have credit cards. They're bad for poor people and they put them in debt and it's all bad. And I'm glad we should get rid of credit cards. Okay. Well, what was pointed out to me was that there's at least 2, maybe 3 airlines in this country that make money from their credit card frequent flyer programs. They make so much money, it subsidizes their loss leader, which is their flight business. They lose money on flights. So what would happen is, if you got rid of credit cards, 2 or 3 airlines would have a choice. They could either go bankrupt because they wouldn't have a solvent industry anymore, or they could double the price of tickets. And once again, airlines would be only available for rich people like it was in the 1960s and 1970s before deregulation, made them more affordable for the middle class. So these same people who are the defenders of the middle class, because they don't respect Chesterton's wall, have gone in here and taken away a great financing opportunity that people always use, which is credit cards. You're going to send those people on the lower end that need credit card debt to the mafia in order to get the financing, the high interest financing that they're relying on. And the rest of us that use credit card debts responsibly, you're taking away all of our cool rewards programs that we like. And then what you're doing is you're either bankrupting 2 or 3 airlines industries or causing them to double ticket prices so that only the rich can fly on airlines anymore. Real great job that you did for the middle class there. And it's because they didn't think through. They didn't give this the rigor of public policy vetting, and they didn't respect Chesterton's wall. Man. That's my biggest problem with these guys.
Yeah, no, well put. I'm gonna have to use that more. Chesterton's wall. A lot of times I use, Bastiat's the seen and the unseen, but I like the change there. I need to update.
Well, the best part about it is because a lot of these guys are my fellow traditional Catholics, and once you bring up Chesterton, it'll make their brains explode.
Yeah. Nice, man. So as we're wrapping up here, Ryan, what would you hope that we see from what the Trump administration is doing to let people prosper, if you will, and deregulation, things of that nature? Like, what are some of the big areas that you're working on, personally, and free the economy and all the other great work that you're doing?
Well, I would say the number one thing we have to do at the moment is we need to make the Tax Cuts and Jobs Act permanent.
Yeah.
As many reservations as I might have about that present policy baseline, if that's the only way we can make the Tax Cuts and Jobs Act permanent, it's worth the risk. We ought to do it. That's number one. We got to make the Tax Cuts and Jobs Act permanent. Number 2, we have to make sure that there's an exit strategy on these tariffs.
Yeah.
If they are indeed doing this as a means to an end, which they keep assuring us is what they're doing, they need to make that end articulated so that we can have an exit strategy and get these things unwound and hopefully end up with a more free market, low tariff barrier, more free trade world than the one we started with, which they say is their goal, right? So we have to do that. Deregulation is a hugely important part of what the first Trump term story was, as you know.
Yep.
It contributed probably as much, maybe even more than the Tax Cuts and Jobs Act did to economic growth in the first term. We need to absolutely do that. And the fourth thing I would say, if I was to sort of lay out some general 30,000-foot advice, is keep destabilizing the swamp.
Yeah.
You have a lot of very uncomfortable people right now, some of whom are my tax clients, reaching out and saying, oh my God, look at all the stuff Doge is doing. It's not rational. They're breaking glass and figuring it out later. They're doing that on federal contracts. They're doing that with federal employees. It's messy. They got to clean it up later. And my attitude is that's the only way this thing's going to change.
Yeah.
You have a totally calcified blob here in Washington of people that go in and out of the government, people that are non-government organizations that receive grants, that hire former bureaucrats. These people go in and out of the government, the media. They're all it's this iron triangle thing like Eisenhower talked about. And it's absolutely true. There's no clean way to surgically dismantle that. You just have to do a Hulk smash thing on it first, which is what Elon's doing now. And then you let the deputy undersecretaries for underwear clean it all up later, right?
Yeah.
And then they make it rational and pretty and everything. But you never get the Deputy Undersecretary for Underwear to be able to do that unless you Hulk smash the entire department that he's in first.
Yeah.
Then you let everybody clean it up and then it's fine.
Yeah. Love it. We need more of that. Maybe that'll be the layout that I use, Hulk smash for this episode. I love that, man. Well, it's always good to talk to you. I think there are probably a few things that you and I disagree on here and there, but for the most part, man, I think we're right on line with we want more free markets, we want more prosperity, and we want people to live their life and have the liberty to do so. And that starts with limiting government. And so I really appreciate all the work you're doing, Ryan, with Free the Economy and everything else you're doing. God bless you and your family. And I hope you have a prosperous day.
All right. Thanks a lot, Vance. Thanks for having me on.
Yeah, my pleasure, Ryan. Well, I hope for you, the audience, I hope you had it and enjoyed this discussion. Please share it with your friends and family. They too need to learn about tax code, what might happen next year, and how to help people be prosperous overall. I hope you'll go and check me out at vanceginn.com or my newsletter, vanceginn.substack.com. And until next time, God bless you and let people prosper.